So they will do multiple asset class. There should be a comma in multiple markets. Multiple phases of development. The whole idea is that I balance my cash flow and capital appreciation, allowing room to maneuver down cycle. In the commercial sector, it's all about the NOI. And it could be like office space. If my office is getting killed, right? Especially Houston, because we had at the time. But if my building is 90% occupied, I can still get the price closer to the price I want to, right? On the flip side, let's say 2 years ago when the market was booming on multifamily, look, I would not be able to sell the multifamily if I'm 70% vacant. The point is, it's all about the cash flow. We can ride the down cycle as you kind of go through if we have cash coming in. And that's why on the larger operators, they look at the cash flow and appreciation balancing out. That should be the same thing for LPs, that you take a look at it from some cash flow, some capital appreciation, some different markets, all that, mixed together, right? Now, the downside is when LPs have to invest in the operator must have deep understanding, like a deep understanding to deploy capital. They really got to be in, like a been there, done that kind of sort of stuff. And operators must have a large and efficient back office, right? Without the back office, without the know-how, they can't tell which way the market is swinging. And then another downside is the investor need to really understand the front office, the back office, and the know-how and the portfolio of the operators, because they're large, right? It's tough to underwrite a large operator versus my best friend who's doing his deal number 2, right? That's one way. One example I wanted to show that here on the focus approach, where less flexibility. About 3 weeks ago, 2.5 weeks ago, I walked the property. Very good team, very good execution of the CapEx. They really did a good facelift of the property, but they did not buy a rate cap. And right now the rate increase. They bought the rate cap, but the rate cap expiring in about sometime this month. And buying the new rate cap is extremely expensive, and they just cannot turn the boat around. They're done. And that project will lose about $11 million of total money. That hurts. But the problem is, it is that. Now, you compare that with the bigger shops who did a fund and who has, let's say, 5 or 10 projects in one bucket, and some here in Houston, some here in Denver, some here in some other, how it's a Texas market. It turned, but they have money in their pocket to buy the rate cap and still make the fund collectively as a whole, or the portfolio collectively in the net positive by managing the risk as you go, right? Or we have had scenarios where things would have gone right if the GP team would have $1 million from their pocket to shell out, or $700,000 to shell out. But that team didn't have the $700,000 out of their own pocket to bring it out to float the deal for the next 2 or 3 years. Deal went bust. On the downside, if you have a large organization and the portfolio, and the GP team or the PE company are making money from the cash flow perspective from one side, and yes, they're willing to pay the fees and get out, which is also why they are professional. They're very tactical about deal making. I always say deal making is a professional job. It should not be emotional. Sometimes we lose the battle, we get out, and we come back out with vengeance, so we make the money, right? So that's the difference between a PEs and a smaller firms and larger firms, right? On the right side, I kind of showed a little bit that as an LP, when you do the investments, look at the top side and look at the bottom side, and look at top, then left and a right. It's a little more complicated, but I'll walk you guys through. Whenever we invest, we have an asset class risk, right? Land, new construction, multifamily, those are different values, but they have a different asset class and asset category. The risk for the land is different than a risk for multifamily, than a risk in a new construction. The return profile is different as well. Same way, Houston has a different risk profile than Austin, which has a different risk profile than Dallas, which is different than I live in Houston, I'm buying the best asset in Houston just because it's in my back door, right? So we look at top-down approach, right? We understand, wherever we go to, we try to understand the characteristic of the city, then characteristic of the sublocation, then characteristic of the asset, on development phase, and also the asset class, then we invest. Last thing, we take a look at exit time. And I'm just throwing some numbers out there. Full disclaimer, this is for educational purposes only. That when you look at it, don't stack every single deal at the same timeline. Everything runs on a timeline, right? If I invest hypothetically 4 multifamily or 4 projects today, and if all of my projects mature in 4 years from now, all at the same time, it's good, but it's not so good, because what if something happens in that year? But ideally, you should phase it out as much as I can. So as you are investing in your time, you are building a portfolio that is maturing at a different time zone. So you are putting yourself on the side of getting your capital back based on a schedule. So from the LP perspective, we believe, hey, this is, you should take a look at it. Look at the asset class, look at the location, and look at that. And then what happens? You're creating a Venn diagram where you're de-risking your portfolio in terms of a time, in terms of a location, and from the asset, right? Which is the cash flow versus the equity. Second slide, I want to give an example of it that here, it's that why they're different. Typically, when you do a deal in Houston, the issues or the biggest conversation is tax and insurance, as you guys know. And then if you look at a construction, the biggest conversation is about the labor cost, because a material cost is more or less the same across everywhere else, but labor costs, they will vary. Retail, it's a big conversation, is cash flow and a debt, right? They're mostly on a recourse debt, versus the multifamily, they're non-recourse debt, right? So as an investor, we should take a look at our portfolio by saying that, hey, I built my portfolio across the geographical location, across the project type, so that our investments mature at a different phasing, at a different times, so you have more flexibility, right? It's also true in real time, you might need some money before that, right? Before 5 years, so you invest in a certain way, and you kind of get that back. Right? So it's a lot. I went rather quick, but the 2 takeaways I want you to do, and I'll take away from here, is that balance the portfolio and the market risk in terms of time and location. Right? And those are very important things. And don't go into doing that, what is the next best thing? Rather go into look at that, I'm going to invest every year X amount of times for next 5 years. So I have that many investment that's going to go out for next year. So I'll decide which way to go, right? Take a look at it a bit more holistically than just the one first time around. So I'll switch that thing to the, so we talked about the portfolio. We talked about LP investment philosophy. Then we'll talk about a little bit more how we use data and tool for massive side, and how we try to be a little bit, on the quantitative side when you look at it. So, and Brad's gonna come and show us a little bit more on the synthesis and RedIQ, how we stack the data. I'll rather quick, kind of overview. So on the left side, if you're in the multifamily, or look at, if you're part of any kind of education group, you'll see the top portion of it, conventional approach, that we use rule of thumb. We compete in the open market. We make generic assumptions, and assumptions looking ahead for 12 months only. Like, everybody who buys apartments, what the first thing we do, we call the broker for underwriting. They give us a insurance estimate, and we plug that in, and we think that is the best cost estimate moving forward. It's a lot of generic. Those are good when market is on our side, not good when market is not on our side, right? For us, we do the conventional plus internal analysis. Nothing is rule of thumb. Everything is specific, right? That's rule number 1, is do not use any rule of thumb. And then we use existing real-time market data for pro forma. Brad's going to show you on RedIQ how you get out the data. We tend to look ahead 36 months for uncontrollable, which is here taxes and insurance, which is uncontrollable. So we run that at a different escalation mode for 36 months. And then internal data set for existing assets. And we try to avoid open market competition, because if we go to the brokerage, all of us, we go to the broker trying to buy that one listing that we have, only thing we're competing most of the time is on the price. And competing on the price is not the best thing to do. Yes, we'll compete when we have some information arbitrage to make sure that we have some other information other teams don't, fine. But in general, we try to avoid open market competition wherever possible. And so that's going to come in another webinar, how we do that. And on the right side, This is what we call it a fishbone model, where every single deal goes through revenue, OPEX, capital, CapEx, and goes internal analysis. And from there, we manage the controllable and uncontrollable. We'll talk about a little bit more how we look at the assumption on the tax and insurance as you kind of go through. I'll give you a case study for Houston. We increase the insurance at a much higher, like if the cost escalation is 3% per the inflation, insurance 10 to 15%. Sorry, taxes 10 to 15%. Or we match the buy price of the property within 2.5 years from today. In Houston, Dallas in a year and a half. And the insurance in Texas, in Houston, down south, it's a double-digit increase versus somewhere else. So that's the difference. And also, we take a look which company has given us the estimate and how much money they're making. Because if they're not making money in a certain state and they're giving us a rate, they're highly likely next cycle they're going to increase the rate, right? We try to manage those underneath that as well. Having said that, Brad, you want to share your screen and take it from here and show us a little bit about the RedIQ and also Synthesis, how we use that?
Yeah, absolutely. Thank you, Shariar. So a lot of familiar faces in here. Good to see you guys. Do me a favor real quick in the chat. Type a 1 in if you're interested in being a GP, and type a 2 in if you're interested in being an LP. I just want to get an idea of who we've got here. Go ahead and share my screen. Let's see. Cool. So I'll go through a few things that show how we analyze. Let me introduce myself first. My name is Brad Pickett. I'm the acquisition manager for Massive. It is a phenomenal opportunity to work with these guys. I've learned so much. I've got like 3 amazing mentors. And over the last, about 6 months, I feel like quadrupled my knowledge and still learning. Multifamily is something that you never stop learning. I mean, it's so vast. There's so many things. You get into commercial as well and all the different asset classes. And it's something that you just continue to have to learn and learn and learn. And so it's been great. My job is to monitor all inbound deals. Right now, Shariar is handling a lot of the triple net and commercial that's not multifamily. So I'm mainly focusing on multifamily. And a lot of you on this call have submitted deals to us as well. So I want to make that available to people. If you do know how to underwrite deals, please don't just send us everything. But if you have a deal that you've underwritten and you really like it and you want to work with us, I'd be happy to look at it. It comes through me. And we kind of take it through this process that I'm going to show you right now. So this is our tracker. And as you can see, guys, we have been underwriting a lot of deals. I think it's over 300.
Okay. Yep.
Over 300 at this point. 2.5 billion in deals that we've looked at. We've got 28.8 under contract. We've got 17 million in LOI stage, and a lot in initial underwriting as well. So as you can see, our deals come in here, they go through our process, and we do what's called napkin underwriting first. And by the way, guys, I do an underwriter series webinar on Thursday nights. I'll put a link in the chat if you guys want to learn more about underwriting. You want to learn about phase 1 underwriting, phase 2 underwriting, rent analysis. We've done all those things. Tomorrow night, we're going to have what's called an open mic. So you just come in and answer questions or ask questions. So everything comes through here. We do a phase 1 underwriting, and we make sure it's kind of like napkin underwriting. We make sure that it works real well. And then at that point, we take it to phase 2, and we go into what is called our synthesis. Now, this is a model. There's a lot of different models you can use. This is a model that is pretty well known in the industry and works really well. So we've been sticking with it for quite a while. I could spend, as a matter of fact, I spend well over an hour teaching this multiple times a month in our underwriter series. So I don't want to go in too deep, but I will show you guys how important it is to know how to model. And this goes back to who do you want to invest with? People that are being conservative and that understand how to model. When I have people bring me deals, it's amazing how often they do not know how to underwrite. And there's big mistakes that can be made. So for example, I just want to point out a couple of things on this. Probably the 2 most important things on this model. Number 1 is your exit cap rate. So as you exit a project, what do you think the market cap will be? So we're 5 years out, right? So we're guessing what that's going to be in 5 years. But if a person gets too aggressive here and they say, oh, I'm pretty sure the market's at 5.5 and I'm pretty sure it's going to get better. So I'll model this at 5.25. Guys, that throws the price of the asset off by $3 or $4 million. This number right here can make or break an underwriting team. So just wanted to point that out, that we're very conservative. Will the cap rates be below 6% in 5 years, which means the value will be higher? Most likely. So we're just putting this as a very high number. The other thing I want to touch on real quick that I see a lot of mistakes with is our rent escalator, right? So everything is NOI driven, everything is revenue driven. It all comes from how much money comes in. And as you're going to grow an asset or increase your rents, a lot of times people will overestimate this, or they'll assume that they can get all the growth in the first year. Well, guys, leases renew over time, so you can't get it all in the first year. So I see people overestimate this, and Shariah and the team has helped me to understand how long it actually takes, because they're operating in all these markets and they've seen it before. They've had many closed cycles, and they've seen it to where it takes a long time to actually hit those rent increases. So we're very careful here. I see people put this to